Welcome to Technical Tools, part of Technical Analysis, the second pillar of investing. These technical tools are going to give us additional insight on price action. But one of the things I think I'll do is, back in this section, I was going to finish this off with filling the gap. And as I thought about it, it's probably not a big enough deal to give it like an entire hour for sure, but it's probably a bigger deal than to just give it a mention. So I think what I'll do is start finish off this idea of gaps, and then we'll hop into to some of the technical tools. So this is an interesting thing. One of the things we're going to find out in the cash flow pillar is the importance of cost basis and getting things as close to zero as we can get them. We love to buy things that are close to zero. When a stock gaps like this one, generally this happens. This is a very strong reaction. I mean, you think about it. Look at the range, the average range of a day in this market, and then all of a sudden you wake up in the morning and the stock's clear down here and falling. So, in one day it goes that big, because woke up in the morning and started downwards here. So those are huge. Now this, I'll give you a clue on who this one is in just a minute. But the question is, why did this happen? And it happened because of emotion. People freak out all the time. There was some type of news that was broken here, something that really changed the story, right? Here we're in this uptrend, and all of a sudden we wake up and, the stock's clear down here, at this level that it hadn't seen in, maybe a year or two, or at least months. And so, it's a big deal, isn't it? To lose all of this in one day. It's a huge thing. So I love gaps. And there's this idea in technical analysis where here's the bottom of the gap that we might get prices right back up to where it was before if we're just a little patient. And one way to look at this is if you've ever had an argument with a loved one, one or two things happen. You either kiss and make up or you don't. And so when we're emotional and we say, oh, you're this horrible person, I never want to see you again, and say all these crazy things. When emotion is high, intelligence is low. And we have this false idea that, well, these guys on Wall Street, they don't have any emotions. Of course they do. They're greedy. And that's an emotion of fear. And they don't want to lose what they have and all this. So gaps often fill. They very, very, very commonly fill their gap. Now, this stock here was a stock called Facebook. And this is the greatest loss in one day of one company ever. There were so many shares of this. It was such a high price that more money was lost in that day than ever in terms of a single stock and the amount of market cap that was dropped. This is the worst single one we've ever seen. And that's why I used an example. And I was very, very excited about this because I thought, okay, why did this drop? Is Facebook fatally flawed? Is Facebook, and it might be, someday it may be, but this is a great example of filling the gap. Now, I did not buy Facebook on this. I was actually in a strangle that kind of bit me a little bit, and we really had to manage this. In fact, this was in the Mentor Club, and we had to manage this and, cut our loss down instead of taking a full loss. So we did a great job. But we didn't lose like $100,000 here. We lost a couple thousand, and it wasn't too bad. But the question we had, and we couldn't answer it about Facebook. We just couldn't because we didn't know. We didn't know. The problems they had. Their earnings are weird, and they're still a relatively new company, believe it or not, compared to someone like GE. And so this filled its gap. So this was a buying opportunity. Now, I don't always hit these, and neither will you. Again, it's fun to learn, it's simple to learn, but it's got to be real. So it doesn't make sense to just have me show you all the brilliant moves I've made. And so this is one I missed. I should have got into that, and I didn't. But is that a mistake? No, because I wasn't confident in Facebook's fundamentals. Make sense? So fundamentals and technicals really, really matter. It would have been nice to pick up Facebook on a discount there. But that's the basic reason why I love gaps. Gaps are often filled where it's a family fight and you're really, really angry, but over time you kiss and make up. Sometimes there's a family fight and it's a divorce and you never kiss and make up. But there is a potential often to fill that gap. So let me show you some that I've done well on and one that I don't know whether I'll do well on or not. Let's get out of this for a minute. I'm going to bring up 3 charts, and this might be a lesson worth doing. I wasn't going to put this in because it's a little more wonky and technical, but what the heck. So here's 3 stocks that I've decided to become involved with, and all 3 of them are with gaps. Now, we'll talk a lot about Kraft Heinz simply because it's a Berkshire Hathaway company, and, you know, I give it a 50-50 shot of recovering or not. You know, it's 50-50. It's always, I don't know, 50-50. But we're in this as of now, and it may work out, may not. We're in this, and we're doing pretty well. And we're in this, and we're doing pretty well. Now, here's what's interesting. This one, we're barely going to be getting into right around now. So we're just the start of this, getting into this one right here. This one we've been in for a long time, bullish. So we're long Coke. And this one I'm bearish, and I'm short GameStop. Now, why is that? Well, the biggest reason is fundamentals. Coke comes out, and Bloomberg, you know, Coke has its biggest drop in 10 years. So when you get a chance to buy Coke $5 cheaper, that's a 10% drop from $50 to $45. That's almost 10% off on Coke. That's a nice discount in my head. So Coke has its biggest drop since 2008 as pressure rises amid tough outlook. And they say, well, maybe people are drinking less soft drinks, and that might be true. There's more health consciousness, and Pepsi's doing better than it used to, and that might be true, and blah, 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 blah. But at the end of the day, it's Coca-Cola. It's second to Apple, or might right along with Apple. That little logo right there is very widely recognized. And I have to say, is this devastating to their case? Is this report of a lowered outlook on February 14th, is it devastating to their case? And I believe the answer was no. So what we did is we sold some puts right here aggressively to get in. We'll talk more about that on the next pillar, cash flow. But it's interesting to look at this gap and see, well, this is a buying opportunity in my eyes. So as we back this out, we sold some puts right here and we waited for the dip to get it put to us. So we got paid for buying it, and it not only filled the gap, but it's forming, you know, it might be slowing down a little bit because we got a bit of a rising wedge in here now, but it filled the gap, as you can see. And what's interesting is once it filled the gap, you see how it shot, and it just did very, very well. So, you know, now we get to pick up a stock at 45, and now it's 52. We get the 10% gain, but most importantly, Coke pays a dividend, and we got paid to buy it here low. So our return on the dividend long term is this. It's a Warren Buffett company. We don't think he's panicked to sell his at any time soon, because we're not so much worried about the stock price. On this one, we want the dividend, and if we can get it lower, we get a better cost basis to receive that dividend. We'll talk more about that in the third pillar of investing, cash flow. So in this case, the gap was really nice for us. Okay, now if I go back though, right? Let's just go back to maybe this type of a scenario. If I go back there, well, why don't I do the same with GameStop? What was it about GameStop that made me say I'd rather go bearish on this? And because that looks pretty similar, doesn't it? I mean, I could even bring in a less history, and I can make these stocks. I mean, almost the same deal, right? Look at this. We can make this look almost the same if we want to, right? Very, you know, big long candle, big gap down, right? So why would I go bullish on this one and bearish on this one? Well, because the news that came out here in GameStop, I believe that company might be in much, much greater trouble fundamentally than the Coke company. So as this one played out and it filled its gap, went into the rising wedge, we're still doing pretty well. Up here at 54, that's a nice. It's $10. That's a big difference. This one has, continued to disintegrate. So I don't show you these because I was right. I just show you these because for education purposes. I showed you Facebook where I was wrong. I didn't get in it. I was in a short strangle. It went a lot bigger than we thought it would. I needed some really fancy footwork to get out of, no question. But so I showed you one that, I wasn't smart enough to get into, and I'm going to show you a couple that we did get into that were nice. So Kraft Heinz is interesting because here's a big gap, and I didn't do anything with this one because I didn't know. And this thing just kept getting cheaper and cheaper and cheaper. It kind of hung in here a little bit. And so this got my attention right here. And when it fell down, it got cheaper and cheaper and cheaper. Right around here, we started to say, we might want to buy this. And we'll go through where we are on this one in cost basis and how we're building a cost basis into this, where we'd like to pick this up around $25. And that looks about like what we're going to do is be able to pick it up around $25. Because we don't think ketchup is going away. And you just look at the reasons they went down, right? This went down because they've just merged. Buffett put this together. That Kraft and Heinz merged, and Kraft got a lot of baggage with it. And this is Oscar Mayer, I believe, as well. And they got some nice brands, but their accounting has been poor. So they brought in a new CEO, and they're laying off workers. And to most people, they think this is something that's very, very bad. They're laying off workers, and their CEO sucks. But when you bring in a new CEO, they tend to clean house, and they tend to. It's just like, every spring when I clean out my garage, I empty the whole thing, clean it all out, and then I throw away what I don't want, and put everything back that I do, and it's nice and clean for a little bit, and then by the end of the year we got to do it again. And I think this is in a house cleaning process. Now I could be dead wrong. This one we knew we were writing because we've had the time to pass to see, and this one we knew we were writing because we had the time to pass to see. This one we haven't had the time to pass to see yet. But I'm going to use this as an example in the 4 pillars because we saw the fundamentals on this popped up on the fundamentals. Why? Well, it's cheap now. It's dropped a lot of its value and it's cheaper. And so now, the cost to buy this now is so much less. So the question is this going to be a Coca-Cola thing or a GameStop thing? And it seems to be lingering, trying to figure it out. Again, we'd like to pick this up around 24, 26, 25-ish. If we can, and so we'll sell puts on this till we get a dip and buy it, or we're forced to use some of those premiums to offset a higher price to buy it just outright. But that's the gap, and gaps just give, in my opinion, there are pretty big opportunities, to pick up a company like Coke on a gap right here. Whew, that's a nice price to be able to get all that run plus all this run. And Buffett just waited this out. He just waited it, and he's got the same run too. He just waited it out, but we took the opportunity to add some to our portfolio. Buffett's got plenty of Coke. He doesn't need any more. And so we have a bearish trade here and a bullish trade here. And the idea here was really fundamentals, right? When we were first seeing the drops, right? Let's go to the big one here. When we first saw the drops, what made us buy Coke? What made us buy Coca-Cola, short GameStop, and sell puts on KHC? We'll talk more about what that selling put stuff means. But hopefully you can see that when there's a gap, God, what an opportunity. What an opportunity often to pick something up. It's risky because it did gap for a reason, but you can always have an exit strategy. And often when something gaps, it's worth taking a little risk. To see if we can fill that gap. So again, there's searches up here you can see for gaps. Let's put that back in theater mode so we can see a little better. We can see searches here for gaps on our technicals, and that's one of the things that I'd be remiss if I didn't talk about. Facebook filled the gap. Missed that one. Gosh darn it, missed that one. Their fundamentals. They're an interesting company. I don't know about their obsolescence risk. They seem to be the guys in the social media, but Pinstagram and all the Facebooks and all the. It's just, I don't see it be hard for someone to write a competitive program and there's enough dissatisfaction with the amount of data that they've collected and how they've collected it, and that business, in my view, boy, it'd be tough to be replaced because it's already so established. But from a standpoint of writing code, and you can say the same with Coke, hey, make a new drink, right? You say the same thing there. In this case, it filled the gap, and so that's what we'll say. All right. With that, let's hop into technical tools. You can tell I love those gaps. They're just opportunities for lower cost basis sometimes. So, and it's Buffett, when everyone else, we try to, be greedy when people are fearful and be fearful when people are greedy. I don't know if that's what Buffett means by that, but it makes sense to me. So these do not protect the future any more than the others. Again, no one's right all the time, so don't expect that of yourself. It's about risk management. There's hundreds of technical indicators, and I said I'd try to simplify this, so let's not try to be comprehensive with all million of these. Let's do about these 4 or 5 right here, and that's a nice, easy-looking chart. And if we took these one at a time, these are some of my favorites. Certainly not all of them that I use, but I think it's enough for a basic class like this, a primer. Let's talk about the moving averages. So moving averages help us understand a trend with proximity. We can see them starting to turn and directions. You can see a slope to these red lines and these blue lines. These are moving averages. And notice here that one is very choppy. See, this blue one is very choppy, and the red line is more smooth. So you can see the red line is smooth and the blue line is choppy. That means the red line is a slower average that takes in more data than the blue one. So let's see how this concept works with going to school. So if I average all the test scores, and I have this great math student that gets an A, an A, an A, and an F, and F, and F, by the time I average all these scores together, he's still a C student. And that's dangerous, because let's say I have a teacher's assistant, and I have this massive class in an overcrowded school, and I say to the teacher's assistant, I says, look, alert me to the kids that are failing the class. But if they're getting a C or above, I'm not worried about it. I'm worried about the guys who are below a C average. So only alert me if you are doing in these test scores and you see someone fall below C average. Well, with that idea, this gets missed because he never falls below the C average, or she. But this is dangerous right here, because obviously these scores do not reflect what type of student this person really is. What I see here, if you go from straight A's to straight F's, something's wrong. And we'd want to be alerted to that. And so if the teacher says, nah, I'm only going to look at students that are below a C, at no time does this person below a C, but I'll tell you what, his parents just got divorced right there. Or he just found out that his dad was on drugs right there. Or he just became involved in drugs. Or his girlfriend is expecting. But something happened here. Something happened here. So the sooner we can see change, the better. Now, when we do this, we can get caught in something called whipsaw, for sure. But what if they did a 3-score moving average where you took 3 scores, 1, 2, 3, added them up and did an average? Then when you took another test, you'd get rid of this score, add up 3 scores, and give an average. Certainly, this score is more damaging than this one. And if you took these 3 scores, take off the last 2, now we're really starting to see 1, 2, 3 where this kid is at. And of course here we have an entirely different result than this one right here. So what a moving average does is it only counts a certain amount of days. So if you have a 30-day moving average, that means that you're only taking the last 30 days of the stock into consideration and plotting a point. And the next day you would take off this one, and this would now be it. You plot another point. You take that day off, add this one, you plot another point. Then it starts going down. Take that one off, plot a point. Take that day off, add another one, plot a point. And you just take the last 30 days, or the last 12 days, or the last 50 days, or the last 200 days. And that's what they mean by moving average, because it moves forward with time. If we did a 2-score moving average, we take 2 scores, not 3. and the next two scores, we'd get rid of the last one, only count the last two, still doing well. Now all of a sudden we're at a C average with just one more test, right? Because we don't count these two. We only count the last two. And now this guy, we're in C. Now instead of a C, we catch it clear down here. We catch it way earlier. In fact, we see this guy as a C student clear back here, where this guy doesn't see him until here. And of course, if we only counted the last score, we'd have caught it here. And we'd have called the kid in, and we'd have said, hey, wait a minute. A, now you get an F. Let's go down the counselor, find out what's going on with you. Let's get this straightened out. We're here to help. And so that's what a moving averages do, is they lag a little bit behind the stock, and we have some interesting things we can have here. Notice that these lines cross right here, and the price is above the fast average, and the fast average is above the slow. So when we see, and notice this, the price is here, so we have price, blue, and red, right? Price, blue, and red. This cross light right here is they call often the golden cross, right? A golden cross. So we have a golden cross, and then the price is above. That would be strength. That would say, hey, we're doing pretty well. We're doing pretty well, okay? Right here, we see they cross. This is often called a death cross. Now, I hate that. And the reason I hate golden and death is, again, do you see how these guys that made up these tools, it's almost if they're predicting something. Oh, here's the death cross. I guess we're in trouble. Here's the death cross. There is some truth that you can find a lot of examples like this. Like George Soros says, we try to catch the beginning of trends, and we try to see trend reversals. And you certainly can find a lot of examples like the one on this chart where that's true. But you can also find stuff called whipsaw, where it crosses, then it crosses again, and it gets off to the races again. But again, we're trying to be intelligent investors and start to combine these factors. Here we have weakness. We have a gap, right? We have a bunch of gaps. So this stock's really in fundamental trouble because the gaps are not getting filled in this stock. And all of a sudden, instead of having earnings dates that are boosting it up, we're having earnings dates that are killing it. And it's below the fast average. So instead of having red, blue, and a price, we have a red, blue, and a price to the downside, which is weakness. Very much weakness. So I could run a search and say, I want to find stocks that are above its 20 and above its 50-day moving average. Run a search and find stocks that are in these types of trends, or I can find stocks that are in these types of trends with searches. So you're starting to get the idea that what if we start to combine all these factors, right? What if we begin to look at all these different factors, and now we see a trend and a bearish candle. We see a trend and a doji. This is stock ABC, and this is stock XYZ. Watch this. Well, before we liked this because it had the doji, but now not only that, we see this one is still below its moving average. This one's above it. This one probably gets the nod from me, apples to apples, as we can begin to combine factors. So all we're doing, and I said this would happen. I said, as you go through this course, you're going to find yourself realizing that I can make decisions based on data rather than just guessing. And while I'll never get to this point where it's just a unicorn to say, oh yeah, I'm going to be able to predict the future 100% every time, that's a unicorn. But you can feel very good, and with proper risk management, you feel great about this stuff going. So here we have some interesting stuff. We have a bit of a double top here. We don't even get the kiss goodbye. It goes straight down here. Bit of a head and shoulders in here, stuff like that. All those different technical things. We have a huge level. This is an interesting level here. We have a pretty decent level of support that when it falls through, it really dies on. And, a lot of pattern stuff to look at here. But when a stock falls below its moving average of a 200-day, that big of a sampling, that gets, when a market or a stock falls below that, it gets people's attention. And so that's another alert. That 200-day is, if you're below your 200-day, you're not in a bullish trend. That's for sure. So here's an interesting thing for 401k people. If you look at the S&P 500 up to the first time it hit 3,000. So I just took 1995 up to the year 2019 when it first hit 3,000. And each one of these candles now represents a month. So we've got a 20-year chart plus, 20, let's see, here's 10 years, here's 20 years. We've got a 24-year chart here, almost 25 years of data. And one thing that's interesting, I'm not giving advice here, but this is called whipsaw, where it kind of goes below, above, below, above, below, above, below, above. Here's a little bit of whipsaw, below, above, not bad. Little bit here. But check this out. What if a person's in a 401k and instead of doing that, even if you were a diversifier and you didn't care about fundamentals, a person that said, if I'm above the line, I'm in, and if I'm below the line, I'm out. And if I'm above the line, I'm in, and below the line, I'm out. And above the line, I'm in, and below the line, I'm out. And above the line, I'm in, and below the line, I'm out. And if above the line and below the line, I'm out, that's pretty cool when you can set up a moving average to say, look, maybe I just am concerned in my 401k once it passes through its moving average. And maybe I sit out for a while. And I don't know how long this will last, but when it goes back above, I get back in. Think about that. What if this were here, and what if this were here, off the chart? Your growth is much, much better if you don't have to participate in these lousy markets. And don't think this can't get back down here again, because it can. It might. If you looked at our sovereign fundamental and took that section of this course, you might think it may get there. So it's an interesting thing that I know it's not going to get clear down here without passing that red line. I'll tell you that. And so some people will do this. They'll just say, look, above the line I'm in, below the line I'm out. I don't think it's the best way to do it, but it does give some interesting food for thought on the moving averages, right? Over a 20-year period, you'd have been maybe out and back in here with 2 trades, maybe out and in here with 2 trades, definitely only 1 trade here, only 1 trade there, only 1 trade there, 2 or 3 trades here, 2 or 3 trades here over a couple of months, 4, 5, 6, 7. It's not bad over 25 years to be able to be in the uptrend. And when we first started, that's how we started, my wife and I. She had an old 401k, and it was around this time right here, and we said, look, as soon as it goes down, we're going to be out. And that was hard to trust because we didn't have a lot of down market experience. But I'll be darned, when it came down, that's the reason my wife didn't lose her 401k money right there. That also is what started my research on 401ks when this did go down. I was like, man, people got crushed. That's not right. And then when do you get back in? Well, it shows strength again. These measure strength and weakness of buying. So it's kind of fun stuff. Let's take a look at the average true range here. And this is a fun one because this will be key when we get into risk management. What this does is it just tells me on average how much this wiggles. Some stocks, this one's gapped a little here and it wiggled quite a bit, and you saw the average true range went up. The candles got really fat here, and so the average true range went up. But when the candles got really, really skinny and didn't move much, the average true range went down. So right now, this stock, you'd expect it to move $4.71 a day either way, is about where it is. And so this helps us with exit strategy, knowing, how much wiggle room should we give something before we call it quits, and how much does it move on average? It's a nice indicator to use exits for. And then finally, we have implied volatility here, and the reason this is important, I've left the corporate actions up here of the earnings, is you'll notice that here it had a little gap, right? Here it had a gap, here it had a gap, no gap here. So why would it gap? Well, information came out that coincided with this. See this? And once the information comes out, the implied volatility will drop often. Whoop, wrong one. Will drop, not there. It'll drop. See these drops in implied? I should draw that better. Here's the corporate action, and here's the drop in volatility. Here is the corporate action followed by a drop in implied volatility. Here's a corporate action followed by a significant drop in volatility. And of course, here's a corporate action, another drop. So we can actually make money on these drops. We won't discuss it now. You can make a lot of money. We talk about that in the Ultimate Options class. But for now, just know that one of the things I'll watch is the implied volatility. See if I can see a pattern of what we call a volatility crush. And when you see stocks that don't really gap too terribly, as a rule, and big volatility, we wouldn't want to put all our eggs in a basket like this, but there's opportunities to be made with the options market on volatility crushes. Speaking of volatility, that brings us to the VIX. And the VIX is called the Fear Index. And this is about insurance premiums, really. I mean, when you buy options, you're buying insurance. And right now, in this one, you can see that relative to its history, in this chart, there would be not a lot of fear. Here is a lot of fear. And I love Buffett, man. I love what he says. We simply attempt, doesn't mean he's always successful, but we attempt to be greedy when other people are scared. And we're scared when other people are greedy. So often, here's where other people are buying, and here's where Buffett is buying. He's buying when they're fearful. And there's an old saying that when the VIX is high, it's time to buy, and when the VIX is low, it's time to go. I don't like that saying because it's too dogmatic for me, but it does lend to Buffett's idea. Last one is going to be the short-term trading index. We call this the TRIN. And this simply has something called the advanced decline line. And what this does is it takes the volume of stocks. We look at the number of stocks that are gainers and the number of stocks that are losers and the volume they're trading in, and it lets us know whether things as a market are leaning bearish or bullish in terms of buying and selling. And so a trend that is less than 1 is more bullish, and a trend that's greater than 1 is more bearish. And I don't use that every day, but I'll check in on it once in a while. Let's take a look at your action steps right here. You've got your coaching group if you're in it. Here we have 20, 50, and 300-day moving averages to look at. We'll check out the VIX as a gauge for fear. Bring up a chart. Find some gold crosses. Find some death crosses. Run a search and start playing with those technical tools. We do a lot of this type of stuff in our coaching. And then run a search for moving averages, stuff like that. So awesome stuff. When we come back, we'll talk a little bit more about putting this all together with technical analysis, because once we're finished with this pillar, we get to dive into cash flow. It's coming quick. Practice. Get ready.